What's up, guys? Welcome back to This Is Not Financial Advice. For the record, this isn't financial advice. This is something that I've been thinking about and doing my own research, and I wanted to share it with you guys. So it's never too late to start thinking about retirement for two reasons. Obviously, the sooner you start planning for retirement, the easier it'll be, the less growth you need every year to compound to have that big nest egg, right? If you have 20 years, you have a lot less pressure on you than if you only have 10 or even 5 years, all right? So whatever your ultimate retirement goal nest egg is, mine's trying to get to at least that $1 million mark. And so that's what I'm kind of looking around to see. Once I hit that $1 million mark with my growth stocks, with my, with the ETFs and all the other things that I'm investing in, what do I do then? Do I start selling off shares to live on per year, which used to be the only real way to do it before all these ETFs came out? Or do we start investing in some good income ETFs? I'm not gonna talk about the super high yield ETFs. Those are a yield trap. Those technically do not produce income because you have to reinvest that in order to keep your total return up. So not even going to get into that, but I want to show you. Let's see, I got 4 here that I want to show you and just kind of bookmark and look at them, do your own research, do your own math on these. So I'm just going to go off a simple number of $1 million nest egg, and we can divide that into 4 pieces. You may want to still hold some growth stocks in your portfolio, obviously, to get that, to build that nest egg up, to start pulling profits every year, to reinvest into these income ETFs. Now, these are all covered call ETFs, but they don't pay out a humongous distribution, so therefore your NAV actually can increase. And I'm going to show you the first one, and these are in order of how long they've been out as far as the inception date. The first one is a S&P 500 ETF by NEOS, and if you look at the dividends, they pay consistently 50 cents. He had 46 cents. This was the tariff dip, but just look at the overview. This is what I like to do. I like to go out to max. And on inception of August 30th of 2022, we hit the market, and here is the big tariff dip. And it was able to recover from that and surpass that, which I kind of like having this on the graph for now. Pretty soon that's going to be pushed out of our 1-year chart as we get past April of this year of 2026. But this just shows you, can it recover from something like that big April tariff dip, when it went down to 42.92. So, if you put $250,000 in this one, you're going to get roughly, like 23 to 2,500 bucks a month from this fund. Okay. So that's one to check out. And again, I just want to reiterate that your NAV is going to go up. So it's not like you feel like you have to reinvest these. You can take 100% of this profit. And if you're in a Roth IRA, and if you qualify for that and you've been building up your portfolio inside a Roth, then all these distributions are tax-free, which is kind of nice, one benefit of a Roth. But let's go to TSPY now. This is Tap Alpha's ETF on TSPY. A little bit different than SPY, but they both do covered calls on SPY, I believe. And again, this one's only 25 bucks, but it pays out 30 cents. 13.75 dividend. It paid out annually of 3. Has it been out for over a year? Yeah. 350 the year, and this one dividend was 615. So even though it is less, SPY has paid out more. Just to keep that in mind. And again, very consistent. That's what I like to see also, is consistent distribution payments. Let's go see the overview. How did it do? The tariff dip. It has not completely recovered from its high back in November of 2024, which was 26.32. But again, a lot of these, when you're getting into them, you want to still buy them as if you're buying it for the growth to get that best value to protect you on the downside a little bit, so you can, you're just buying it. You always want, obviously, you want to buy everything as cheap as possible, just saying that. Next one on the list is fairly new. It's a KQQQ by KURV. they do a really good job at managing their funds. Again, it is we have that tariff dip to show, can it recover from a down market? And it absolutely can. Everything recovered from that. So, and again, you're diversified in all of these. This is not just single stock risk. That's why I like these, why I pick these. So we got single stock risk, we got consistent dividends. Now KQQQ has not shown consistent dividends, although it seems like they do not pay out more than they can handle. Like some of these high yield ETFs, even if the fund didn't make money, they're still going to take it from the NAV and pay you a high distribution. So those are why those are so risky to me. But over the long term, this seems, and we don't know yet because it is fairly new. It came out in 2024, boom, and then it recovered, and it's up 12.3%. So this one could prove to be even better than holding QQQ itself if you were to reinvest the dividends, but that's not what this video is about. This video is about taking 100% of your distributions and still having your nest egg intact. That's the whole point. You either have to sell your nest egg a little bit every year and try to live off whatever the 8-10% is, depending on how big your nest egg is. Sell calls or, sell options on the shares that you have if you built up, over 100 shares of a bunch of different stocks, which can get, that's very inconsistent because premiums fluctuate due to volatility and all that kind of stuff. So, again, this is something to consider. Doesn't matter how old you are. You want to be planning for retirement. The other thing too is, what if you inherit $1 million tomorrow? Are you ready to deploy that and know what to do with that? So that's something to think about, and something that I know I've not inherited $1 million, but I wanted to be ready and have the knowledge in case something like that happened. Even if it wasn't $1 million, say it was only $50,000. Do you know what you would do with that money if you were surprisingly inherited that kind of money? So just throwing that out there, something to think about. So you always want to have a game plan, no matter how much or how big your portfolio is, and you always want to have a goal and a means to get there. Steady and being patient is the key. So here's a new one, Tap Alpha. The holdings are with the QQQ again. I like QQQ. It's a little more volatile than SPY, but it tends to produce stronger yields over the long run. And again, everything is just subject to when you get in. Let's see what the dividends are on this one. It's only got 3 dividend payments, paying monthly at 38 cents. So far, pretty consistent. We haven't really seen any down market for the 1 year. What is it? Yeah, it looks good to me. Well, last September is the only thing we got to go off of. So year to date, we're up 1.3%, paying. Has it paid out? Hasn't even paid out a dividend yet this year. So check those out. Leave me a comment below if you have any other, good, solid retirement focused, pay ETFs that pay a good dividend. Hey guys, thanks for watching. We'll see you in the next video. Bye-bye now.